You could buy a house with less money down, a lower interest rate, and no bank approval at all. No credit score, no tax returns, no underwriting. Sounds crazy, right? This is actually one of the oldest ways people used to buy homes, and it's making a huge comeback. We're going to break down seller financing, so called owner financing, what it is, why sellers love it, why buyers love it, and how you can use it right away. If you're a buyer struggling with banks or a seller sitting on a paid off property, this video may completely change how you look at real estate.
First, let's talk about what is seller financing. It is basically you take the bank completely out of the equation because with seller financing, the seller acts as the bank. The buyer makes payments to the seller directly or through escrow. You're buying the house on an installment plan. You still have some of the same core elements as a normal real estate transaction. For example, you're going to have a purchase price, you're going to have a down payment, you're going to have an interest rate, monthly payments, and you're going to agree on some loan terms. The only difference really is who is receiving the payment. With a bank loan, you're paying the bank, but with seller financing, you're paying the seller. What is the difference between a traditional loan and seller finance? Again, in a normal transaction, the bank is the one that's controlling everything. They ask for so much paperwork. They decide how much you can borrow, what the interest rate is, how much to put for a down payment, and whether you're going to be approved or denied. So it's a lot of hoops through to jump through. So it can get complicated and a little bit frustrating with when you're trying to get a loan through a bank. But with seller financing, the thing that's so freaking awesome is that everything is negotiable. Everything. Obviously, the sales price, the interest rate you can negotiate, the down payment you can negotiate. And in some cases, like Lynn, don't even pay a down payment. Or I've even seen some people where they even make the down payments in payments. So everything's so negotiable. Same thing with the loan terms. It could go 30 years, it could be 50 years, it could be 20 years. It's just a very flexible way to acquire a property because, again, it's between you and the seller. And so it's an extremely powerful tool, especially in the market that we are in, especially during high interest rates. But the other thing that to keep in mind when you are talking about seller financing, you might hear the term balloon payment. It's a very important thing to understand because with seller financing deals, you may have a balloon payment. Matter of fact, most of them do. So, what is it? It's just a way, like a fancy way of saying, when does this loan get fully paid off? When you do, your deal with the seller and y'all agree, like, let's say a 30-year mortgage, or you're going to pay it off in 30 years, you might have a balloon payment at like the 10-year mark or something like that. And so you're kind of like confused. It's like, what does this mean? It just means at the 10-year mark, they want you to like pay it off. And so it could be 5 years, 10 years, whatever they decide, seven. It could be whatever crazy number that they want. But at that timeline is when they want all their money for that house. So for example, a deal that I was working on and it was going to be amortized for 30 years, but at the 10-year mark, he wanted it fully paid off. So that was my balloon payment. Now, ideally, with seller financing, because everything's negotiable, you want to go for just having a regular 30-year amortization and no balloon payment, meaning you just have a loan with, well, you owe the seller a monthly payment for that 30 years. So that way you don't have to worry about having to come up with the full amount at 5, 10 years or whatever y'all decide. But it's a little bit tricky because not every seller is going to agree with it because who wants to wait, 30 years for all their money? It's still out there. Some sellers do that. My parents, that's how they got their first home was through this way, through seller financing, and they did a 30-year. They paid it early, but they were willing to wait the 30 years and just receive monthly payments every month. So it's out there. It's just more than likely you're going to have a balloon payment.
So, why would a seller even do this? If you think about it, we have passive income. Instead of getting a lump sum, the seller collects monthly payments plus interest. Over time, they can actually make more money than selling the property for cash. Another reason is potential tax advantages. Instead of paying capital gains all at once, the seller spreads incomes over years, often resulting in lower annual tax liability. For example, if somebody bought a house 10 years ago for $100,000 and the house has appreciated and now it's worth $400,000, that means the seller has a capital gain of $300,000 that they will have to pay capital gains for when selling conventionally. With seller financing, now you have that spread out over the course of possibly 30 years, resulting in a less tax liability. You, as the seller, can dictate it can be a 10-year, a 20-year, it can be interest only. You can customize this however you want to structure your seller finance deal. So if you were hesitant about selling your property or you were already an investor and you had tenants and repairs and maintenance costs, then you don't have to worry about that because now the property is all on service by the buyer and you're just going to become the bank and receive payments. And there is a potential for no agent commissions. So if you involve agents in between the transaction, you don't have to give up 6% of the profit to an agent. So that results in more gains for you. That alone can save you thousands of dollars.
Now, on the buyer side, especially as a real estate investor, there are so many benefits. So, like, easier than going through a whole going to go get a bank loan or even a DSCR loan. That's because with seller financing, you can put less money down. It's just whatever you can get the seller to agree on. With a deal that I was working on, it was only like 10%, 10 to 12% versus the 20-25% that I usually have to put down with a regular conventional loan. So already that's a big win. I've seen some people that can say, "Hey, let me finance the down payment as well. I'll pay it to you in the first 3 months or whatever." And so like everything's negotiable. And same thing with the interest rate. You can get a low interest rate. Sometimes they might ask for like a higher interest rate. But depending on what you're trying to do, if you're just trying to get a property that might need some rehab, and then you use that as a way to just get into the house, fix it up, and then go refinance it into a regular loan or whatever. That could be an advantage as well. But of course, you also have the opportunity to get a way lower interest rate than what's in the market. And you don't have to go through the bank. You just skip the bank altogether. So that means you don't have to worry about a credit score. You don't have to worry about, scrambling around looking for those tax returns or last 3 months worth of your bank statements and so on. There's a lot of paperwork that goes with the bank loan. But with seller financing, just so much simple. Is just like it's like what you agree on. So you'll have like those documents of everything that y'all agreed on, and then just your down payment and just a few extra things, and that's it. It's so much easier and you could close even faster because of that. It's just really on the timeline of like the title company or whatever. But again, everything is negotiable. And I know it can sound risky because you're like, well, you're directly involved with the seller. I'm worried that they might just take my down payment. I'm scared that they might rob me or whatever. There's a lot of concerns there, of course, with seller financing, but seller financing has been around for like decades. Again, my parents bought their first home in 2009 through a seller finance deal with a family member. You just got to do a few extra things to make sure that you protect yourself. So let's talk about the types of seller financing. You have several kind of levels. For example, number one is holding the title, holding the paper, holding the mortgage, the note. There's several different names for it. And this happens when the seller owns the home free and clear. There's no mortgage. and they're settling their home. So then they're like, okay, they do a seller finance deal. So, for example, let's say again, a seller owns the house outright. They bought it for 100K and now today it's worth $400,000. That's a $300,000 gain. So if they sold it for cash, then like Lynn was saying, you would have to pay capital gains tax and the depreciation recapture and so many things that you have to think about when you sell a house. And so let's you would be walking away with maybe 200K. But if the seller decides to do a seller finance deal, then all that gets spread out, the capital gains tax and all that stuff. And so let's say they sell the home for $400,000. The buyer puts down 20% down and they agree to an interest rate of 5%. And it's amortized over 30 years. That means over 30 years, the seller's collecting 618,418 and 31 cents over those 30 years. So now, instead of the 200,000, they're getting 218,000 more than if they just sold it for cash. You can see there's a lot of benefits as a seller to want to do a seller finance deal. The problem is that because it's not the norm, a lot of sellers kind of are like hesitant to do that. So, not everyone knows about these things. But again, they get lower taxes over time. They get a monthly passive income. They don't have to deal with the property or headaches because now the buyer is responsible for fixing up the property, all that stuff.
And I'll be honest with you, this is an expert level strategy. So we didn't start here. For example, I hit a wall. I used my own money to buy houses conventionally, and then I moved to leveraging HELOCs to do a burst. But one day the money was gone. And when I learned about creative financing, aka seller financing, it sounded like a made up concept to me. I didn't fully believe it was real. So I told myself I needed to do at least one seller finance deal just to prove that it actually works. And then, so one of the things that I did is because I never done such a deal and I didn't have a mentor by my side, I definitely partner up with my realtor. And my realtor is an investor friendly realtor who has done these deals before. So he actually understood and walked me through a seller finance deal. My goal was simple, just to acquire one seller finance deal, no exceptions. So my strategy was very specific. Every deal that I analyzed needed to cash flow at least 7%. My cash on cash return needed to be at least 7%. So when I was putting offers, I normally was coming maybe 20, 25% under asking, sometimes even lower. So this only works if a seller is extremely motivated. But that was the whole point of me making offers. So in order for my seller finance deal and finding a motivated seller, I would present two offers. One that was cash offer with my realtor and one that was seller finance. The seller finance offer was always at full price and my cash offer was always lower. So sometimes 10%, sometimes 20%. I was getting rejected multiple times, but that's okay. That's the name of the game. Eventually, something changed. So in my agent's network, because he's a investor friendly agent, he has other investors in his network. Another investor wanted to offload the properties for the market that I was buying. So he connected us both. This previous investor, was open to seller financing. So this is where it got interesting because instead of looking at the purchase price of the property, I looked at the monthly payments. So because I was looking, my strategy is at 7% cash to cash return, I can work a deal from the monthly payment. So that's the question I would like you to ask you. How comfortable are you with the monthly payments? And then also the next question that I would like to ask you is how much rent can you get? When you know these two numbers, then the deal starts to make sense. Here's how the deal came together for me. The house that I was looking at was a 3 bedroom, 1 bathroom. The purchase price was 82,000 and we agreed on a 10% down payment, which is 8,200. The interest agreed upon both of us was 6%, amortized over 30 years with a 15-year balloon. The property had already a tenant in place, paying 1,100 per month. My all-in PITI came out to 642. And normally I say 23% aside for property managers and then vacancy repairs, capital expenditures. So that left me with $847 net. After subtracting PITI, I'm cash flowing $200 per month. That's at around a yearly return of 2,460 over at 8,200 investment, which comes out roughly to 30% cash on cash return. And the best part is I did it without a bank. And I know I just threw a bunch of numbers at you, especially if you're not experienced, especially if you don't have a team on the ground that is going to manage your properties, or if, for example, it's not in your backyard. I invest out of state. I have a team on the ground. I have a realtor, I have a property manager, I have contractors. My purchase price was negotiated, my interest was negotiated. There is a balloon payment, which is I'm not a fan of, but I have 15 years to figure it out. And I'm taking over the tenants, right? Which could be a problem. But again, my out of pocket investment is really low. And over the course of 30 to 15 years, the seller is going to benefit from monthly cash flow because I pay monthly right on time, even 2 days before it's due every month. So he doesn't have to worry about their tenants that are there. He doesn't have to worry about capital expenditures for that property. And if I default on payments, he can always foreclose on me. So there is protections on both sides. And then so when you're scared about going through this transaction, you do know there are so many components on the deal. And do reach out to people that have gone through this already. Like my realtor, he told me exactly what to do, how to structure the offer, how to look at the monthly payments and work backwards. Me from being in the market already know what insurance is going to cost. I'm able to calculate how much taxes are going to be triggered upon reassessment, so I can run my numbers very conservatively. And again, we have a point of connect there between the seller and the buyer. Even though I had to pay in this particular case an agent commission, I'm still walking out with this transaction with the house, cash flowing house, in less than whatever it cost me to buy it conventionally. And that is what I'm looking at, the gains of the transaction. And once I started, I couldn't stop. Violetta will tell you.
For financing is a really great tool to start buying um, investment properties when you don't have that much cash. I mean, she got a cash flowing property for like 8K, uh, and now she has another property to cash flow. But there are some things, of course, like Lynn said, that are a little bit risky. Make sure you have the right team. Make sure, you, like Lynn mentioned, you find a realtor that understands how a seller finance deal works and how to help you structure and stuff. And make sure you go through a title company. Like, don't just go out there and go get with the seller and assume because you don't know. You want the title company, to do their research and make sure that the title is free and clear, because that's the last thing you want to find as a surprise, that you are buying a property that has like all these extra liens on it or whatever. And number 2, that they actually own that property, because not to, like, scare you off, but there, especially in the rural areas, there's some scams going out there, especially if they see, like, a vacant lot or a home that's kinda run down that nobody seems to be like, it's vacant. That possibility is out there, so when you're out there negotiating and you find a seller finance deal with the down payment as well, use an escrow company. So that way you don't give your down payment directly to the seller and then they take off on you, and now you're out of that down payment. Have a real estate attorney look over the contract to make sure that there's no like craziness in there. But most of the time, if you have a realtor, they already have like a seller finance kind of a contract there. You could go with the realtor, or if you don't go with the realtor, then make sure at least you get a real estate attorney to look over the contract and make sure that nothing crazy is in there. But again, it's a great way to get into these properties, especially in a slow market. You just got to just do a little bit extra work, know your numbers, like Lynn was mentioning, make sure that you know the terms that you want and are worth it to you to make sure that you're actually cash flowing and finding a profitable investment property. But again, if you're a buyer trying to avoid the bank, or you just don't have enough funds, or you find a property that is not going to qualify for a conventional loan, because that's a great way to get these rehab properties as well. This way is a great way to get your foot in there and get your first investment or next investment property. And it's something that a lot of people don't know. A lot of sellers don't know, because some of these properties are just, regular home buyers that they've been living in this property for like 20 plus years. And so they go put it out there. So sometimes you could, like Lynn was saying, she submitted 2 offers and see what happens. Doesn't hurt to try. You might end up with one. So let us know any questions that you might have on seller financing, and don't forget to subscribe, follow the podcast, and we will see you in the next one. Bye.